But let's welcome on board Sunil Subramaniam, find out what he's making of the market texture right now. Sunil, hi, good afternoon. Good to have you on the show. Looking at the DMAT numbers, doesn't seem like the market should have any problem. But the FII participation, Sunil, does it seem like it's going to come anytime soon?
No, I think it will. That's just a pause because of the January beginning. All the fund managers have gone on leave. I'm sure some of the hedge funds would have booked profits in December. They will now look to redeploy that capital. So I think just give it a few days and they will come back strongly, because I think the move in December is a part of a larger move I see till the elections, because I think that's the biggest positive for FIS has been the policy continuity they can expect with the election results going the way of the India government. So I think oil prices are also predicted to be stable over the next few months. So I don't think there are any concerns as far as India is concerned from a foreign investor. Our valuations will always be there, but I think that given our stable growth, if you look at our EPS growth and the market volatility is much less than world market, I think we will continue to receive flows from FIIs. This is just probably the first week of January. It's just a bit of a holiday mood there.
Well, yes, holiday mood. But Sunil, is this the reason that you guys have launched this multi-allocation fund, which is looking at investing right from an equity to a debt to money market instruments and gold ETFs? Tell us, what should be the rationale in investing such kind of product in the current market scenario?
So I think it's not so much about the market scenario as much as the fact that we've done a long-term correlation analysis and found that whenever equity doesn't do so well, gold steps in and does well. So it makes sense in any equity customer's portfolio, because countries go through business cycles. There are always unexpected events like COVID or wars that happen when equity tends to react negatively, and more often than not, gold does well in that period. So I think that it makes sense for almost every equity investor to have some proportion of gold in their portfolio. Now you can choose to buy gold through jewelry, you can buy gold nuggets and keep in your locker. On buying gold ETFs, which was an increasingly favorite of investors, the finance bill took away the taxation benefit on indexation last March. So as a result now, multi-asset funds are the only way that you can buy paper gold in a tax efficient manner. So I think what our fund proposes to do is for a moderate investor who wants long-term inflation and fixed deposit beating returns, right, with lower volatility, a blending of gold and equity in the same portfolio achieves a sharp reduction in risk, but with not a commensuration return in reward. So over the medium term, you still can expect double-digit inflation and fixed deposit beating returns with equity taxation. But the rolling returns analysis that we have done for the fund's benchmark shows that if you stay invested for 3 years, then the chances of loss are almost nil, because gold steps in whenever equity falls. So I think that is an ideal product for every equity investor to have some portion of gold. For people who want to not be managing this separately, this represents a tax efficient way of ensuring that your wealth creation happens with the least risk and volatility.
That's quite interesting, Sunil. But what's the, the main counterpart, that's equities. Within the equity class, where is it that you are, concentrating your bets? What are the sectoral exposures and classifications like?
So I would say first that we'll probably be large cap oriented throughout, because we recognize this is for a moderate investor, and so probably small caps will not be a big proportion of portfolio. We'll use 75 to 80% large caps and 20% in mid caps. So that's one. Second is we are looking at the average investor staying invested for 7 to 10 years in this fund. So in a time like that, the business cycles obviously go through. So we would arc the portfolio around the India growth story, which is essentially the manufacturing, consumption and services sectors. So banking, IT, the industrial space, all of these would form a significant part of the portfolio. We run a well-diversified portfolio with 50 to 60 stocks. We have chosen the Nifty 500 index as a benchmark. And as you're aware, it has 75% large caps in it. So our portfolio would be large cap oriented, but over the medium term, with increasing FII interest in India, we think that large caps will give you less volatility, but very healthy double-digit returns over the medium term. So that portfolio should serve that purpose.
Right. Well, today, of course, you're seeing the European market start off well into the red, and I guess that is what's been sort of rubbing off on our markets as well. Of course, the Eurozone inflation data is due, and you are seeing the US pre-market rates as well, largely within, snapping their 9-week winning streak. Sunil, if there is to be an aberration in the market, you think that's going to be more global triggered, or would you say the market, because of the run-up that we've had ever since the state elections, is just going to choose to consolidate, buried under its own weight?
See, if you look at it, right, most of the events are taking positive for India. The only thing I would say that is that the private sector capex expansion hasn't kicked off in the way it was anticipated about a year or year and a half ago. That's because I think capacity utilization, after rising sharply post the second wave of COVID to about 76%, has kind of stagnated. So while there are a lot of private sector announcements around capacity expansion, the ground level work hasn't started. So I think a delay in the capex expansion cycle is probably the one key risk, I would say, because a lot of heavy investment has gone into the infra on the anticipation of this big perk up in manufacturing. And so if the story is getting delayed, there could be a reallocation of that same money into consumption and into banking. So I feel that a reallocation within the market is what is more likely than a universal correction in the market. So you'll see winners changing hands, and I expect consumption and banking to be leaders of the next growth in the market. But that might come at the cost of infra and manufacturing from a stock market perspective. Bear in mind that from a medium term, I don't see the manufacturing as dropping in share of the GDP. I see it growing, but the stock market always goes through these valuation cycles, and there I feel that there could be some reallocation of money within the market away from the manufacturing infra space to the consumption banking space, and hence overall market returns might not be as strong, double digit 20% plus as in the past, and would be moderated down to a mid double digit kind of a return in the market.
Mid double digit is still not a very bad number at all, Sunil. So we'll take that, and of course a bit of a churn to the underperformers. The financials and consumptions might be on the cards for this year. But Sunil, hold that thought. We'll do one thing. We'll slip in a very short break. We'll shortly be back and discuss more stocks with our guests.
The closing trades surely are getting wobbly, so we've now given up most of our morning gains, dipped into the red, and now again beginning to see just that wee bit of a perk up. Having said that, couple of stocks which are holding out well. Adani Ports, of course, has been a big mover today. There's TCS, Indus Tower, and then, of course, look at the spike up that you're seeing in Spark. And this is not just today's move. Even yesterday, the stock was a big mover in trade. In fact, in the last 7 days, the stock has actually managed to post a stellar 60% off again. But what's been sparking this move? Let me take it across to Srishti and find out exactly why. Srishti?
Well, yes, a sparking move coming in on Spark, which is a Sun Pharma subsidiary, and this research division, the stock has done pretty well in the past 7 odd days. We have seen the stock jumping around 60%, and one of the key triggers for this particular company is their ongoing program, which is related to the Parkinson disease. The drug is actually under the phase 2 trial, and the company has announced that they're gonna be coming up with an update on to their trials, as well as some more updates awaited in the analyst meet, which is going to be tomorrow. So tomorrow we're going to be having an analyst meet for an update regarding to their vodobatinib Parkinson disease program, and along with that the company will also participate in JP Morgan's healthcare conference that will be on 10th of January. So definitely a lot of interest coming in on Spark when we talk about this particular drug. Then vodobatinib is undergoing the trials for 3 critical indications, not just for Parkinson's. This is also being treated for the Alzheimer's disease. So all these trials are going under process, and Spark recognizes that vodobatinib is a breakthrough in the study of the brain-related disease. In the trials that the company has done earlier, one of the reading was there in October 2023 as well, and the company has come out with great results on that particular research, and along with that the analysts are anticipating that the interim analysis completion can be done by March 2024, and Spark aims that the interim readout and the phase 3 initiation could be by November 2024. And another interesting point is that if this goes through, then there could be more collaborations coming in, because this could be a breakthrough drug for Spark, because the potential peak sales of vodobatinib for Parkinson's disease is valued at $5 billion. So the market opportunity is quite huge. This is undergoing trial, and if this goes through, it could be a big trigger for Spark, not just for the treatment of Parkinson's, but also it's being treated for Alzheimer's, which also has a big potential. So that's why we are seeing no stopping on a stock of Spark. So all eyes will be on the analyst meet as well.
Oh, yeah, absolutely. If the drug does manage to get final nod coming in and does pass through all the regulatory moves, this is going to be quite the breakthrough if it does materialize. That's Spark in trade for you. In just the last 7 days alone, it's managed to knock out almost 58% of gains. But Sunil, a lot of pharma interest as well coming back. A lot of pharmaceutical stocks as well we've seen have really seen that revival come in. And, you know, in the absence of IT, pharma is being looked at the best hedge in terms of a defensive play. What do you make of whether pharma is good for an investment?
I think it's good, because I just spoke a few minutes ago about the reallocation of capital away from the manufacturing infra capital goods space, because of it's run up a bit ahead of the numbers. So I think that reallocation, pharma will also be a beneficiary, because if you look at FII flows, right, when they come into an emerging country like India, they prefer safer stocks within a risky emerging market. And historically, IT has been their favorite, banking was also been their favorite, but FMCG included. So now if you look at it, IT, because of the world slowdown, the prospects are not looking great. So a little bit of valuation correction upside will be there, but not from a growth perspective. And on banking, you know, I think while in the long term banking is a good play and I expect the reallocation to benefit, the FIIs in our large cap banks, I think probably from a valuation, because if you look at it, the large private sector banks are mostly retail oriented, and you've had the recent RBI regulations around retail lending and around NBFC lending kind of cool things off a bit there. So I think the next journey is more of a corporate bank kind of a journey, and so from a large cap bank's perspective, you know, that strong buying will probably take a bit of time. So I think pharma is the beneficiary, because pharma is a business which is resilient to economic downturns, right? It's because people falling ill and needing medical treatment and all of that is constantly being a continuous demand. So the volatility of pharma is less. Second, I think Indian companies, the non-software services exports, right, in management and professional consultancy, pharma is a big place there because of our vast resources of the PhDs in the pharma and the scientists and all of that. The third thing which is helping pharma is that domestically post-COVID, there's been a huge shift towards people taking more insurance to protect themselves, and diagnostics and hospitals all are seeing a surge in their business once people insure themselves. So I think the domestic pharma story adds value to an international, which is more of a generic and product kind of a story, to a more of a hospitalized. So a broader pharma pack is tending to get a lot more buying support, and I would say yes, it's a safety pick. It is proving to be among a better one than IT at this point in time.
The stock price moves as well. Sunil, good to have you on the show as always. Thanks for taking the time out and speaking with us.